Oh, lady speaking to me. So the purpose of this evening is very much to look at the SEIS and EIS schemes to give you a sort of overview of how they work, what they're there for, and what we can do with them. Um, Before we start, I'll tell you a little bit about us. We are a law firm. We've been around about 15 years now. I set up the firm originally back in 2011. Prior to that, I had been working for two big New York law firms, so doing sort of half billion plus M&A, so sort of the big city deal stuff. I came into startups from a slightly odd route. Back during the banking crisis in 2011, there wasn't a huge amount of sort of M&A work, the stuff I was doing around. And I blagged my boss one day and said, you know what, we should work with startups. And at the firm I was at, it was a big firm. Startups was very much unicorns and sort of slightly bigger businesses. But to my frankly astonishment, my boss said, "Yeah, great. Go out and get some startups, and we can work with them." So I sort of built up a small startup practice at the firm. The market came back. The banks were doing big deals again, and I was sort of moved back onto to sort of big transactions. But by that point, I'd really got the startup bug and really enjoyed what I was doing. So with their permission, I left. I set up Buckworths and took with them that sort of small number of, or took with me that small number of startup clients. We're interesting in that we work exclusively with startups and scale-ups. So lots of our bigger firm competitors, they do bits of startup stuff. This is everything that we do. And the nicest thing from my perspective is every week I get across my desk, I don't know, 10 or 12 different businesses. So founders all doing all sorts of weird and wonderful things. The interesting thing for me is I've been doing this 15 years. I still cannot, in those initial meetings, tell you which startups will be successful and which startups won't. And the reason for that is that successful startups essentially need three things to come together. The first thing is they need a business idea that can grow and scale. So an investable idea or a scalable idea. The second thing is they need to execute it right and not make silly mistakes, not sign things that are going to cause them problems, potentially terminal problems in the future. And the third thing, if we're all being honest, they need a bit of luck and a bit of timing. This session is very much about that execution piece. So making sure that you're doing the right things today to get the right investors at the right time, and also making sure you don't do stuff that screws up SEIS and EIS and potentially causes you lots of problems in the future. So we're going to cover the stuff on the slides. The first half of the presentation is a little bit more technical, so we're going to talk about sort of the rules of the scheme. The second half is a little bit more practical, so thinking about what you can do to sort of raise investment, how you can make sure that you're getting the best investors and maximizing your investability. So before we start, just a little bit of context. And this is really just to remind you that investment is one piece of your fundraising journey and your fundraising opportunities. It isn't everything. So please remember the other sources of funding. And in particular, I just flag grant funding. So if any of you are doing something particularly innovative in sort of tech, med tech, biotech, pharma tech, have a look at Innovate UK. So Innovate UK is the government's grant funding platform. They have lots of competitions available for innovative startups doing stuff that fits into a segment that the government is sort of trying to promote at the moment. Those grants are huge, and in the main they are free cash. So very much worth looking at if it's suitable for you and if there are competitions that are relevant. Grant funding is very helpful when it comes to raising investment. So it's something you'll often do with investment, not least because a lot of the grants require what's called matched funding. So, you might get £1 million grant, but you'll need to raise £1 million of investment in order to unlock it. Investors, for obvious reasons, love grant funding because it's non-dilutive. So it's free cash, no shares are issued, it's often not a loan, doesn't have to be repaid. And it shows investors that Innovate UK and the specialists who review grant applications believe that your business idea has got legs, that it's doing something generally useful that can grow and scale. So have a think about grant funding. So, what are we talking about when we think about SEIS and EIS? What we are talking about are schemes that apply to investment and specifically equity investment. So, when we think about equity investment, let's just very quickly think about what we're doing. So, we are issuing new shares to investors in consideration for cash. So, they are investing into our company. They're paying money into the company's bank account, and the company is issuing new shares to them. So the really important thing to remember is you're not transferring any of your existing shares. So if today you've got 500 shares, after the investment round, you will also have 500 shares. All that's happening is new shares are being issued in addition to those that we hold today. There are really two types of investor in early stage investments. There are angels who are high net worth individual investors, and then there are funds. Now, funds come very simplistically in two sort of types. We have what we call SEIS and EIS funds, and then we have mini VCs or full VCs. When we're thinking about SEIS and EIS, we're thinking about angel investors, so individual investors, and we're thinking about SEIS and EIS funds. So, what those SEIS and EIS funds are, by the way, is they're essentially fronts for a bunch of angel investors. So, imagine you have 100 individual angel investors. They've come together and they have got the fund manager to do the sort of the hard work for them. So the fund manager negotiates the investment docs, the documents. They do the due diligence. They make sure this is an opportunity that is a good investment. They then recommend it, if you like, to the angels who sit behind them. And then the angels decide they want in or they don't. Those who want in will invest, and the investment will come through the fund, and the shares will be held by a nominee company. So a non-trading single company that is often controlled and managed by the fund itself. That entity will hold the shares for the investors. So those are the sort of structures and the types of people that we're talking about. The crucial thing for these two schemes is that it's individual investors investing either directly and holding the shares themselves or through a nominee, and the nominee holds the shares for them. So there are two schemes that we are thinking about here: the Seed Enterprise Investment Scheme (SEIS) and the Enterprise Investment Scheme (EIS). SEIS is, if you like, the baby scheme, and EIS is the bigger scheme. So for SEIS, we're talking about the first £250,000 that a company raises from angel investors or SEIS funds who are looking to claim these tax reliefs. So SEIS is the first £250,000. EIS is the next 10 to 12 million pounds. So you can immediately see EIS is a much, much bigger scheme. And it's a slightly weird one. A lot of early stage businesses will talk about SEIS, and that's what they will focus on because, as we'll see in a sec, it's got the best tax reliefs associated with it. But actually, ironically, EIS is arguably more important because it's got much, much more capacity for you to raise. You can raise 10 to 12 million under that scheme. So what these schemes are designed to do is they're designed to reduce the risk that investors take when they invest in startups. So the policy idea behind all of this is that investments in startups are extremely high risk. There's a horrible stat that many of you will be aware of that, I think it's 65% of startups go bust within the first year. So it is risky investment for investors. So what policymakers are trying to do is they're trying to encourage people with a bit of cash to make these risky investments. And they do that by giving them a huge amount of tax relief. So the first bit of tax relief is an upfront income tax relief. And under SEIS, it's 50%. And under EIS, it's 30%. So if I just take SEIS as the example, so imagine that I invest £100,000 into your company under SEIS, that baby scheme. HMRC will give me half of that back, so £50,000 back, as a credit against my income tax liabilities in the tax year I make the investment or the preceding tax year. So as long as across those two tax years, I have paid or will have to pay £50,000 worth of income tax, I get that back. So I've invested 100, I've got 50,000 back from HMRC. I'm only at risk for £50,000. So that's the big tax relief that a lot of angels will be thinking about and focusing on. The second tax relief that is absolutely vital and is the really, really valuable bit to this is the last one in the list of tax reliefs on that slide. So it's the 0% capital gains tax on sale. So normally, if you sell shares or you sell an asset and you make a gain, you will pay capital gains tax at your marginal rate. Now, with SEIS and EIS, you have a tax-free exit. So it doesn't matter how big a gain you make, you pay no tax whatsoever. So to put this in context, and to give you an example, we acted on a transaction at the end of last year, just before Christmas. One of our companies, our clients, was sold for about 80 something million pounds. There was an investor who'd invested into that business under a mix of SEIS and EIS, and he'd invested a total of £420,000. When he sold his shares, he sold them for just under £26 million, and he didn't pay a penny of tax. And so immediately, hopefully, you can see if you are a relatively high net worth individual, not only does it make sense to make the investments in the first place because you get the tax you would otherwise have paid back from HMRC, but also if that investment does well, you've got a huge amount of tax-free income that's come from it. So those are the two big tax reliefs that almost all angel investors are looking for. However, there are three further tax reliefs that often get forgotten. So the first one is there's a capital gains tax relief when investors make the investment, and it's slightly different between the two schemes. So under SEIS, if an investor has disposed of an investment asset or a rental property, something like that, and they've got a capital gains tax liability to pay on any gain, if they invest the gain into a startup under SEIS, they only have to pay half the capital gains tax. So they reduce their liability by half, and they get that money back. Under EIS, it's a bit different. So same scenario, they've got a gain that they would otherwise have to pay capital gains tax on. If they invest that gain under EIS, the bigger scheme, then the tax liability stays in place. So it doesn't disappear, but it's delayed until they sell those EIS shares. And what a lot of investors will do is they'll actually roll that liability again and again. So imagine I have a £100,000 gain on sale of a rental property. I invest that into a startup under EIS. I get my upfront 30% tax relief, but I don't have to pay the capital gains tax on the disposal that I would otherwise have to pay. And I've rolled that into the EIS shares. I hold the EIS shares, say, for 5 years, and then I sell them. Now I have to pay that deferred capital gains tax liability that I didn't pay 5 years ago. But if I invest the money again into SEIS or into EIS shares, then I can roll it again. And we have clients who roll these liabilities again and again and again and again. And being slightly flippant about it, they end up leaving it as a problem for their kids when they pop their clogs. So it can be a very nice tax relief to delay the tax liability. The second tax relief that actually is increasingly very important and people are paying a bit more attention to is an inheritance tax relief. So you've probably all spotted the government are doing all sorts of things to effectively increase inheritance tax. With SEIS and EIS, if you pop your clogs, or if an investor pops their clogs, and they've held their shares for 2 years, those shares pass to their beneficiaries tax-free, regardless of value. So there's a nice inheritance tax relief there. On the downside, so let's say the business fails, or it's sold in circumstances where the investors would suffer a loss. then there's some downside protection called loss relief. And loss relief is quite interesting because you can set it against income tax or capital gains tax. So most people who are still working, and they're at working age, they would be setting losses against income tax and they'll get a reduction in their income tax liabilities. People who've retired and perhaps don't have income, but they do have capital gains on disposals, they can set it against capital gains tax. So hopefully you can see there's a lot of tax relief using these schemes, it really is very beneficial to investors. It's about, I think, 96% last time I looked of individual investors investing in startups who are using these schemes. So they are very, very popular. There are some requirements, and we'll talk in a sec about them, but the really headline requirements that I would flag on this slide are that we're only talking about startup companies. So, if you've got a company that is turning over 100 million and it's, a very established company, investments is, if indeed you needed it, would not attract this. So it's very much startup companies. The money has to be used for growth, and this is something we'll talk about in a sec. But you can't use tax relief money to just pay off debts or to stop your company going bust. The money has to be used to grow revenue, employee numbers, and customer numbers. You can't give extra protections to investors. So investors get what we call ordinary shares. Those are shares with a voting right, a right to profit, and a right to proceeds of sale. You can't give them, multiple dividends, multiple or preferential treatment on an exit. You can't give investors using these schemes security over assets. They have to be fully at risk. And in terms of the types of business that the schemes apply to, it's actually most startup businesses actually qualify for these schemes. The things that don't qualify, the professions, so lawyers, accountants, architects, those sorts of things, anything to do with exploiting property. So if you are a property developer, you're setting up a hotel, those sorts of things, they don't qualify. Anything that involves rental of assets. So if you were setting up a car hire company and you're going to hire out cars to people, that won't qualify. Banks, by which we mean, businesses holding deposits, so almost like neobanks. Most fintech does actually qualify. And then businesses dealing with crypto, that's a gray area. So it can qualify sometimes, and sometimes it can't. The point there is if you are trading crypto and a significant proportion of your income is coming from the increase of the value of that crypto, then there's a good chance that you won't qualify. If you are a tech platform that happens to provide a crypto service, then you should qualify. What I would say is if your business is in any of the sort of gray areas, you definitely do need to get advice on it, because the problem with these schemes is they can look very straightforward. Actually, they're extraordinarily complicated. If you haven't realized the complexity of your particular sector or your particular business, things can go, really quite horribly wrong. So on to the detail then and the numbers. So as we said, for SEIS, the baby scheme, it applies to the first £250,000 of investment that you raise from investors qualifying for the scheme. EIS, the next 10 to 12 million. You have to issue the SEIS shares within 3 years of the date that the company starts to trade. Now, for these purposes, commencement of trade is usually when you have your first revenue. So it's not incorporation necessarily, it's first invoice, first revenue. You've got 3 years from that date to issue your SEIS shares. By the way, it doesn't matter if you don't issue your SEIS shares, you can still go on to do EIS. For EIS companies, you have 7 years from commencement of trade by default. And some special companies, effectively companies that are doing lots of research and development activities, they're called knowledge intensive companies. They have 10 years from commencement of trade to be able to raise investment under the EIS scheme. At the point that SEIS shares are issued, the assets of the company cannot be more than £350,000. And that excludes, for these purposes, the SEIS investment. We'll talk in a sec about some of the gotchas and the things that can go wrong here. But this is one of the things that catches out a disproportionately large number of startups. So what a lot of startups will do is they will raise SEIS and EIS together. So their first round, let's say, will be £1 million. They will quite often have all of that money paid into their bank account, sometimes even before the docs are signed, but definitely before they get round to issuing the shares. So let's just imagine you've got £1 million worth of investment monies in your bank account. You then come to issue the SEIS shares, so £250,000 of those shares. The cash in your bank account contributes towards your gross assets. So you have got gross assets of more than £350,000. So if you now issue the SEIS shares, SEIS will be voided. You won't be allowed to claim it. You'll default into EIS. So it's really, really important when you're doing an SEIS and an EIS round together, or if you're doing SEIS and no tax relief together, that you don't take any money beyond the SEIS money into your bank account before issuing those SEIS shares. Once the SEIS shares are issued, then you can take the rest of the money and you're fine. The maximum amount that any angel investor can invest in all companies that they invest in any year is 200,000. So one of the sensible things to do when you're lining up SEIS investors, just check they haven't exceeded that limit in other companies they're investing in. Process-wise, it is frankly pretty straightforward. So there is a voluntary procedure that HMRC operate called an advance assurance. So this is something that you don't have to do, you can do. My advice to you is you absolutely do need to do it. And what it is it's applying to HMRC for a confirmation from them of two things. Number one, that the business that the company is carrying on or plans to carry on will meet the rules of the scheme. So it's called a qualifying trade. And the second thing that you're asking for is that the investment that you're taking on is going to be spent in a compliant manner within the rules of the scheme. Potentially, if there's complexity, so if you've got foreign connections or something like that, you may be asking for further things. But those are the sort of two main things. Now, it's a really, really important point, this. The advance assurance is only binding on HMRC to the extent that you tell them all relevant information and that the information you give them is 100% accurate. There's no defense whatsoever for I didn't realize, or I didn't realize that I didn't understand what I was doing. And what that means is if you give them the wrong information through no fault of your own, you don't realize what you've done, or you don't give them all the information that they need, they may give you an advance assurance, but then later they may void the tax relief. So it's very, very important to make sure that you really do know what you're doing. And if you're not sure what you're doing, that an accountant or a lawyer submits that document for you. Now, the reason I say it is voluntary, the reason I say you should do an advance assurance is really two things. Number one, almost all angel investors will want to see that you've got assurance because they want some comfort that HMRC has thought about this and that the company qualifies. The second thing is when you eventually come to claim the tax relief, if you've got an advance assurance, the process is pretty smooth and HMRC deal with it quite quickly. If you don't have an advance assurance, they will ask lots and lots of questions, and sometimes it can be really quite a painful process. Often the questions they will ask aren't questions that you can answer. They become very technical and very legal. It's going to cost you potentially a chunk of money getting a lawyer or an accountant to respond to those questions. If you've done an advance assurance in the first place, you don't have those problems. So it is a very good idea to do that advance assurance. Once you've got the advance assurance, what you do is you give it to the investors. They are super happy and excited that you are qualifying. They sign the investment documents, put the money into the company's bank account, and the shares are issued. Once the shares have been issued, then you, the company, will send a form to HMRC. and it's called an EIS1 or an SEIS1. And what that is doing is it's confirming to HMRC certain information about the investment and asking HMRC to give you an authority to send a form to the investors that allows them to claim the tax relief. The form you give them is called an EIS3 or an SEIS3. And they use that, they give that to their accountant, and they use that to claim the tax relief through their tax return. Massively important point. It is a very, very serious criminal offence to give an investor a form SEIS3 or an EIS3 if HMRC hasn't explicitly authorised you to do so. So please, whatever you do, don't assume because you've got an advance assurance that the investors are entitled to claim the tax relief. They're not. You have to wait for HMRC to approve the SEIS1 or the EIS1. So super important point that. Most investors are going to claim the tax relief in January. So when they file their tax returns in January, meaning that now is when they probably pop up and say, "Ooh, have I got, I need my SEIS3 or my EIS3." So try to make sure that you submit the forms to HMRC as soon as you close the round, and then that you send the forms on to the investors as soon as you have the authority to do so. So things that can go wrong. The way I would sort of say to think about these schemes, SEIS is technically a lot more simple and straightforward than EIS. Also, HMRC as a rule of thumb, they don't really look or relook at SEIS claims, whereas they do scrutinize EIS claims. So if you are doing something that is absolutely qualified for the absolutely sort of central to these schemes and quite clearly qualifies. So for example, I don't know, you're a software as a service business, or I don't know, you're a restaurant, all that stuff should very simply qualify. There's probably minimal risk in you doing the SEIS Advance Assurance application yourself. If you completely hash it up, HMRC will reject it, or they'll come back to you and say you need to provide further information, and then you can either get a lawyer to help you or not. EIS, though, I personally would suggest you get any EIS application to be done by a lawyer or an accountant. Technically, the rules are much more complicated, and there's lots and lots of complexity that can catch you out. So the couple of points we're going to run through now are some of the things that add a bit of complexity. So the first one is a company raising tax relief under these schemes must have what's called a permanent establishment in the UK. Now, most UK companies would, but two things to think about. The first one, if you are a foreign company, so I don't know, you're a French company, French companies can claim these tax reliefs. But what they have to have is they have to have this permanent establishment in the UK. And in layman's terms, that is generally an office here, key members of staff here. It is possible for a UK company not to qualify for these schemes. And the classic scenario would be all the founders are abroad. There's no UK connection. You don't have an office here. You're not employing people here. Nothing is really happening in the UK. In that circumstance, it may be you do not qualify. So it is important, if you think you fall into either of those scenarios, to again talk to a lawyer about it and make sure you've got it right. The company can't be controlled by another company. All that means is there can't be another company, like a holding company, who owns or has the ability to exercise voting rights over more than half the shares of the company that's raising investment. The gotcha here is, if you've got a founder who, let's say, holds 50% of the shares, and for whatever reason, there is a company that has invested in the share capital that is controlled by the founder. So there's lots of scenarios where that can happen. And even if that company has a tiny percentage, the company is aggregated with the founder that controls it and is deemed to hold and exercise all the voting rights of the founder. So in my example of a founder with 55%, a company controlled by them with 0.00001%, that company controls the company, and you immediately void SEIS and EIS. So again, don't any corporate shareholder that is controlled by a founder, you need to get legal advice. That's probably the way to put it. The company must be must own and have created substantially all of the intellectual property that it's commercializing. What this means is you need to make sure that intellectual property that is being used by your company is created within it. There's a couple of sort of practical points here. Number one, if you're going to raise money with these schemes, you want to incorporate the company sooner rather than later. So don't try and run the business as a sole trader for an extended period of time, because if you create too much value outside the company, you can actually find that you fall foul of this particular rule. And the second thing is you need to make sure that that you're not sort of licensing in huge quantities of IP. So you need to own it, and it needs to have been created by the company. Investors can't be employees of the company, and they can't become employees of the company within 3 years of the date that they make the investment. Again, this is a really easy and quite common problem. You've got an investor who invests, they love the business, they get involved, they add a load of value. At some point, they become an employee. As soon as that happens, if it's within 3 years of the date of their investment, their tax relief is voided and they have to repay it. So don't do that. Investors, when they invest, cannot hold any shares in a company on which they haven't claimed SEIS and EIS, or which were incorporated which were issued on incorporation. So the problem comes here. Let's imagine you've done an investment round. One of the founders leaves. He offers his shares or some of his shares for free to the rest of the shareholders. So it's a sort of typical founder vesting leaving situation. Shareholders take up their rights. They get some shares from the founder for free, and they're super happy about that because it tops up their shareholding. Because those shares are not eligible for tax relief, those founders cannot make those shareholders who hold those transferred shares cannot make a further investment under EIS in the company. So again, it's something that we see more often than not. Clients come to us, they've had this sort of circumstance of share transfers. Shareholders have taken up their shares. They've made subsequent investments under EIS, assuming that they qualify. And then after the facts have realized or been told that they don't qualify and they're not eligible for the tax reliefs. So again, anything to do with share transfers, once you're up and running, you just need to talk to lawyers about it and make sure that they're done in a way that works and or investors understand the implications. Investors, together with any of their people connected with them, can't hold more than 30% of the share capital. This is why this is why founders normally are not able to invest under these schemes, because you quite often find founders hold more than 30%, meaning they're automatically disqualified. But it also means that founders' parents may not be able to invest either. So parents are connected with their offspring. If a founder plus, I know, dad who's put some money into the company together hold more than 30%, dad can't claim the tax relief either. So that 30% number is super important. And then the other thing, we talked a moment ago about the advance assurance, really important that you give HMRC the right information and all of the information that they need to see. So that's a sort of overview of the schemes. When investors make an investment into your business, they are likely to be using one or two instruments. So the first option for them, I should say, by the way, it may be that you decide which approach you want to take. It may be investors tell you which approach they want to take. But either way, to be honest, either of these two approaches end up in pretty much the same place at the end of the day. So the first approach is that the investors sign a subscription agreement. A subscription agreement is basically a document that says investor pays money to the company today, and the shares are issued straight away today at a valuation. So it will, the principle may be, I don't know, I'm an investor, I'm investing £200,000 at a valuation of 1.8 million. And so I am going to get 10% of the share capital. So nice and straightforward. From a lawyer's perspective, by a million miles, the best way to do this, for the very simple reason it minimizes any risk of SEIS and EIS being voided. the money comes in, shares are issued, everything is done, send the tax relief to HMRC, we're all very happy. The second approach is an advanced subscription agreement, also called a seed fast, a safe. There's a couple of different sort of names for them. The way that this works is the investor invests the money today. So they put the money into the company's bank account today, but the shares are not issued until a later date. And that later date tends to be one of the company's next investment round and 6 months from the date of the investment, whichever comes sooner. So really, really important point with SEIS and EIS shares, those shares must be issued within 6 months of the date the company received the money. If they're not issued within 6 months, you can void the tax relief. So with ASAs, what you're generally doing is saying they either convert at 6 months, or if there's an investment round before 6 months, they will convert probably at the price per share paid by the investors in that round, or maybe a discount to that price. I am going to grab questions at the end. If you've got any questions, pop them into the chat, and we can run through those at the end. So why use an advanced subscription agreement, other than there is a commonly used legal tech platform who strongly advocates that people should do this? Theoretically, the reason to use an ASA is because it allows you to delay the valuation of the business. And the theory goes, once you've got your cash, you can spend it, and hopefully within 6 months, you will have been able to significantly increase the value of the business so much that you can pull off a price round at a much, much higher valuation than you would be able to do today. My 10 penneth on that is it rarely ever happens. I can think of clients who've done an investment round within 6 months, but it's very, very few and far between, particularly in the current market where rounds are taking a bit longer. The second argument that people put forward for using ASAs is that it allows you to raise money from lots of different investors sort of over time. So you don't have to line everybody up into a round and then do it all in one go. That's rubbish. We very, very frequently will do priced rounds, so subscription agreements with multiple investors, and each investor signs a subscription agreement when they're ready to go. If there's an investor next week who wants to do it, they sign a subscription agreement, and so on. We can structure those in such a way that there are potentially multiple share issues or one share issue. So my sort of comment is I see little benefit between for using an ASA versus a priced subscription agreement. The risk of using an ASA is that you guys forget to issue the shares within 6 months. And I see this increasingly going on all the time. We have clients come to us, they forgot to issue the shares, or perhaps they didn't realize it mattered. They've gone and issued the shares after 6 months, and HMRC are avoiding tax relief. So I sort of would say to you, there's nothing wrong with either approach, but think carefully about whether an ASA really makes sense, because you are increasing your risk by doing it. You can manage it by being super organized, but there's a bit of an increase in risk there. So in terms of preparing for investment, what do we need to do? And what sort of is important? My first thing would be you need to be absolutely brutally honest and realistic about your business. What do I mean? It is very easy to exist in a box, right? So you've got your business idea, you've spent 6 months, 12 months, however long it is, thinking about it, doing business plans, putting together your forecasts. In your head, this is a really, really fantastic business. You may have got feedback from your friends, from your family, all of whom are biased and all of whom probably are going to tell you it's a great business. And what that can mean is that you start living in an echo chamber where you verify everything yourself amongst your friends and family, and you are absolutely convinced you've got a fantastic idea. What you have to do is go out into the market, get people who don't care about you and don't want to make sure you're happy to give you feedback. And I guarantee the best ideas have been massacred by the public. So go and get that feedback because investors are probably your harshest critics. So go out there, test the idea, get people using it, whatever your product is, but get that feedback. Um, the hardest thing I think for startups is getting feedback because it can be brutal and it can be really negative. You should try to flip the narrative in your head. If people give you brutal feedback, whether you agree with it or not, there is something helpful in there. It is somebody out there who doesn't think your idea is a good idea. You have to sort of take a step back. What is it they don't like? Why are they saying that? Is that something that other people are saying? And what can you do to resolve it? So feedback is helpful, but you have to do that before talking to investors. Build your network. From today, if you're not doing it already, go to networking events, talk to people. Tell everybody who will listen to you what you're trying to do with your business. That is the way to build a network so that when you need to raise investment, you can reach out to that network and say, does anyone have recommendations about investors who will invest? Would anybody like to invest? It's so much of an easier process if you've done the groundwork today to get your investor network in place. Just to give you an example, and it always amuses me about the sort of talking to people thing. About 7, 8 years ago, we had a client come to us. Funnily enough, actually, just before Christmas, and we were super busy. So normally, when clients come and talk about investment rounds, I'll have a conversation with them and find out what the business does. And because we were so busy, I'd had a very brief conversation, and long and short of it, it was a social networking platform that was matching people with people. We did the round, everything was happy, and went through fantastically. And about this time of January, I sat down with the founder and was like, tell me a bit more about the business. Is there anything else we can help with, etc., etc. And the business was basically a platform that matched homeowners with cleaners who were going to clean their home. The weird thing about it was that the cleaners were going to have no clothes on and they were going to clean the home naked. Um, I thought that was an odd idea. I think probably my view matched with the market because he went bust within it was about a year or so, blew through the investment money and then went bust. Um, Probably should have tried the idea out with people before raising the investment. But anyway, he came back about 2 years later with a new idea. And as you might imagine, I very quickly asked him what this idea was. And the idea was basically quite weird. Was that it was going to be, again, a social networking platform that was going to match people who like dressing up as puppies. So very weird thing this, but there is a community of human beings who like dressing up as dogs, and they sort of go to parties and bark at each other, essentially. Um, very weird stuff. The purpose of my story, why is this relevant? So he had raised his investment from in both circumstances actually from people that he had spoken to when he'd been going out sort of clubbing and going out to parties. And what he was doing is he was going out to parties and whatever, and he was telling people about his business idea. They were getting enthusiastic and they invested in his business. So that classic example of that sort of networking thing. I had another client who was on a flight to New York, chatting to the lady next to him. It transpired that she was the founder of a very big New York VC. And as a result of that conversation, that VC invested over £100 million into his startup over the space of, 6, 7 years, all because he was sat on a plane and was talking to this lady next to him about his business. So talk to people, get that sort of network thing moving. It really can pay dividends. Getting public messaging right, I think, is super important. What I mean by this is the following. When clients come to us, let's say we're doing an advance assurance for them, they will often send me a pitch deck. I'll have a conversation with them, and then I'll go and find their website online. And more often than not, what I find is that those three sources of information say completely different things. So their website will not match their pitch deck, and their pitch deck will not match what they tell me they are doing. Now, the reason for that is obvious, and I get it. These things move, early stage business ideas move very fast. They put together their pitch deck perhaps quite early on. It's pivoted, they haven't updated it. The website might have been the first thing they did. they haven't looked at it for 6 months. All of that is understandable. But when you are talking to investors, the three sources of contact, they have to say the same thing. So your pitch deck needs to match your website, and it absolutely needs to align with what you're telling investors you're up to. So make sure that that is done right. Um, if you are launched, you've got a product or service in the market, and you've got a significant number of customers, sometimes customers can be a really good source of investment, particularly if you're a kind of product that's got buy-in, and particularly if you've got higher net worth customers. So think about maybe raising from customers. And then finally, you must have your financial documentation in place. So the first thing you need is 3-year forward-looking profit and loss forecasts and cash flow forecasts. My top tip is you must do these yourselves. So increasingly what I see is AI generated forecasts. They are uniformly garbage, a waste of your time, a waste of investors' time, and the single quickest way of getting an investor to not progress with you. So my tip with this would be as follows. Do the forecast yourself. Why? Because you're the only person who really can understand the basics of how your business is going to work. You also need to know the numbers. So do the research, think about what your costs are going to be, when they're going to kick in, how many staff you're going to take on, what sort of revenue we're targeting. Put together those forecasts yourself. Then, if you want, ask ChatGPT what it thinks. Get your put it through AI and get some feedback from there. Get an accountant to look at it. Get friendly investors or founders to look at it and get the feedback on it. But you have to do the heavy lifting yourself. You need to do those forecasts yourself. In terms of finding investors, lots of sources of investment in London. London is we read about a recession, which don't get me wrong, I think there is one. We read about a credit crunch, which to a degree, there is also a credit crunch in the startup market. But London is still an amazing place to raise investment, and there is an insane amount of money around. So what do you need to do? Well, number one, you've done everything I've said. You've built your network. Tap up your network. See if there are other co-founders who can recommend, maybe intro you to funds or angels. You have to do a bit of cold calling probably. So reach out to the early stage funds or perhaps funds in your sector who you would like to work with. Top tip on this, make sure that you, I'll come back to that. Go to networking events. Like, you have to do it. It's part of building the network, but you will find that there are actually, if you go to the right sort of sector specific events, you'll find there's lots of investors there. I would never do a hard sell. Chat to them, tell them what you're up to, get some feedback from them. If they like the idea, they will want to connect with you. So don't do hard sell at pitching event at networking events. Just use it as a chilled, fun way of sort of building a network. Go to pitching events. Now, with pitching events, there are two types of events. There are events where it's free or very low cost to pitch. Those are generally actually, I would say, a good idea. There are some where they're charging you a stonking great fee. As a rule of thumb, I would say they are a waste of money. Now, there are exceptions, but as a rule of thumb, if somebody's asking you to pay 1,500 quid to pitch, I suspect it's not going to get you the results that you want to get. And part of the reason for that is the VCs who are most active tend not to engage with pitching organizations who are charging a huge amount of money. They tend to be much more enthusiastic about engaging with the people who are doing pitching sessions for free or just for a nominal charge to make sure people attend. Think about maybe accelerators. So accelerators are businesses that will sort of theoretically get you from where you are to being investor ready. So the way they tend to work, they may or may not invest a lump of money into your startup. You will issue them with shares. They will then often take that money back as payment for their fees. And they will introduce you to a bunch of experts and subject matter people who will help you get to a point where you are ready to invest. Now, with accelerators, there are some astonishingly good accelerators, the best one in the world, in my opinion, being Y Combinator. You've perhaps heard of it, an American accelerator. There are also some shockingly bad, rubbish accelerators. Your job before signing up is to do your research and figure out whether the people you're talking to are in the good category or the rubbish category. Do not believe the portfolio company lists on their websites. So it's a funny thing. If you look at almost all of the, or not almost all, but if you look at a lot of the accelerators in the London market, you will see that most of them have worked with Monzo, Tide, Starling. That is not necessarily because they are astonishingly good accelerators and they have added huge amounts of value to those businesses that have got them where they are. It's because those businesses went through loads of accelerators because they were building investor networks. So what you need to do is reach out to the portfolio companies, particularly those in the current portfolio, see what they think. Is this good value? Are they getting something out of it or not? You'll get quite honest feedback and make your decision based on that sort of feedback that you get. And finally, for those of you who are Brits listening to this, British people are very bad at boasting and telling people what we're up to and all of our successes. Be more American. Talk about your progress, post on social media. And by the way, sometimes this is what I would view as quite banal. So some of the most effective things I've seen are people sort of posting about, they've just achieved this milestone. They've just launched their website, or they've just signed their first client, or they've just got a term sheet from this investor. It's relatively banal, but it shows progress. It keeps people interested, and it can help you sort of generate interest. Just before we go on to questions, I wanted to talk just very briefly about solicitors versus legal tech, because it's something that we're sort of increasingly getting asked about. So legal tech is great, some of it at least, and I think it has a place in this space. But I think you just need to remember the difference. So legal tech is about a deliverable, right? They're giving you a document and it's a process, and they're getting stuff done. Solicitors theoretically should be giving you advice. What I think sometimes is missing from the sort of legal tech piece is an understanding of or advice on what is market standard, what should you be agreeing and what you should not be agreeing. And so my sort of take on this is, again, SEIS round 250K, legal tech's probably fine. The precedents aren't great that you find with legal tech. There's lots of reasons why we don't like them, but actually for the first £250,000, it's probably fine. You're going to rip those documents up when you do your next round. It's not the end of the world if there's a few sort of issues in there that aren't great. Once you get to bigger rounds, though, particularly if there's any complexity, I would suggest you sort of work with a solicitor, because it's gonna help you avoid the screw ups and the things that can go wrong. On the compliance side, one of the things that legal tech platforms do not do is they do not ensure that your investment is compliant. And this is much more relevant now than it was last year because the rules on compliance have changed. So there's a couple of things that we think about. The first thing is money laundering and sanctions. So from this year, it is now a criminal offence for directors to inadvertently be involved in money laundering because they haven't done the right checks. So just to give an example, if you go and take money from an investor and that money is the proceeds of crime, whether it's terrorism or whether it's drug money or it's just they've stolen it, you as a director can be criminally liable. It is also a strict liability offence to allow someone who is sanctioned to invest in your company. And just as an example of where this can happen, someone who is resident in Russia is automatically sanctioned. So it's not just oligarchs, it's any person resident in Russia. And what we're seeing is a lot of Russian residents, they are investing through Middle Eastern companies or companies elsewhere to disguise the fact that they are Russian. if you take money in breach of sanctions, you commit a criminal offence, and it's a very serious one. You can go to prison for it, and they are beginning to prosecute for this stuff. Um, Solicitors should be doing this for you, so there's a touch point for us to make sure that's done right. Um, when you take investment from an angel investor, again, criminal offence if they have not signed a certificate confirming they're high net worth or sophisticated investors. Now, actually, more seriously, in a way, um, if you do take investment from someone who hasn't signed that certificate, you as individuals can be personally liable to repay their investment to them if the company goes bust. So, financial promotions regime compliance, also pretty important stuff. And finally, just as a heads up, there is a lot of fraud around at the moment. So many of you will have been approached on LinkedIn by people saying, "We'd love to invest in your startup," and often that outreach will be a little bit unexpected because perhaps there's not a huge amount of information about your business online, and perhaps they're offering something that is way too good to be true. So we had a client who has basically just got a business plan. They've got a sort of shop window website, and they got a reach out through LinkedIn. Somebody wanted to invest 1.5 million in their startup at a 5 million valuation. Now, I can tell you right now that business is not worth that. The amount of money that they're looking to invest is way more than would ever make sense. And nobody legitimate in their right minds would want to invest based on the website they've got because it has no information on it. That kind of stuff more often than not is fraud. So I think just be aware of this sort of compliance stuff. If you get it wrong, the implications can be horrendous. So you can end up with big legal costs trying to resolve the problem, huge amounts of reputational damage. The company can go bust. So getting this stuff wrong is obviously not something you want to do. As I say, there is a place for legal tech, but I think on more complicated transactions, you probably should be getting lawyers involved. And actually, lawyers on this kind of stuff are generally not really much more expensive than the legal tech would be. Before we go on to questions, then, just a list of my favorite investors at the moment. So, SFC Capital down there in the bottom corner. They are the most active early stage fund in the current market, in the London market. They do a huge amount of investment. Their team is kick-ass. They're really, really cool. They're a very, very nice, supportive investor. And they open doors. They know lots and lots of people at the bigger VCs. So they will open doors for you when you want to do your next round. Hatch, very active currently in the market. They work quite closely with the British Business Bank, which is the government's sort of startup bank. More often than not, if you raise a round with them, you'll do part of it as an investment from Hatch, part of it as an investment from the British Business Bank. So often it doubles the money that's going into you. Gradient is Google's VC, amazing VC. We have a number of clients who've taken money from them. They're really on it. Great connections, particularly on the US side, and a really good bunch of people to work with. GeForce is both an accelerator and an early stage fund. So they invest in environmental tech, sustainability, all of that kind of stuff. So if you're in that space, definitely reach out to them. Again, very, very nice bunch of people. They're backed by Founders Factory if you've come across them, and definitely worth sort of talking to. Ascension and Fuel, again, early stage funds, very active in the market, really good team who we like very much. BGF, British Growth Funds, they are doing lots of early stage investment as our Connect. So those are the sort of early stage funds that we are seeing most of in the market, and who, at least from my side, I think have a really good reputation and are worth talking to. If you would like any further information, there's lots of stuff on our website. Built on Rock is a book I wrote a couple of years ago, which covers all the stuff we talked about and also sort of all the stuff that you need to think about as you set up a business. You can download an e-copy and get a free copy of the book there. And if you wish to book a call with me or to play with our SEIS EIS eligibility calculator, you can scan the QR code and book through there. Wonderful. If you've got any questions, chuck them into the chat. Ivan, do you want to run through
Yes,
them?
thank you so much for the insightful presentation, Michael. If you guys have any questions, feel free to share them in the question and answer box and we'll answer them. So we do have a couple to start with. We've got a question from Sandra. Can the investors be friends?
Yes, they can. So friends are absolutely fine. The only thing you need to be aware of is that financial promotions regime bit. So your friends need to either be high net worth or sophisticated. So sophisticated investors are investors who sort of regularly invest in startups, or perhaps who work in venture capital or financial services. So that's the bit there. High net worth, they need to have salary above a certain level, or assets above a certain level. And top of my head, I can't remember what the hell they are. I think it's a. I'm not going to guess. So just check that. If you've got friends who want to invest and they don't meet either of those requirements, then they unfortunately would have to get independent financial advice. So they would have to talk to a financial advisor, who would essentially say to them, "You shouldn't make this investment; it's highly risky." But as long as they get that advice, then they can invest. But yeah, those are your options essentially.
Thank you, Michael. We've got a question from Anna. How long does the advance assurance take? I'm also a EU national. My company itself is incorporated and headquartered in the UK. Does my company qualify?
So the process takes 4 to 6 weeks. So basically, we get a list of information from you. We can generally get that put into the letter that we send to HMRC within a couple of days. So imagine that from the point that we get the information, we sort of submit it within a week, and then HMRC take about 4 to 6 weeks to respond. At the moment, they're a little bit slow, so it's more like 6 weeks, and it's just because they're busy at the end of the tax year. Normally, they take about a month. Um, in terms of the nationality of founders, that rarely matters. The nationality of the company, so an EU company can qualify for these schemes so long as it has that UK permanent establishment. So long as it has a serviced office here, a WeWork or something similar, and it has key members of its team here. Um, if you're just a single founder company and you don't really have much presence at the moment, there are ways around it. Best thing to do, ping me an email, or book a call with me, and we can talk about sort of what you can do to make sure you qualify.
Mhm. Thank you, Mike. Next question is from Sanjeev. Does biofuel R&D is eligible?
Um, Possibly yes. It's actually one of those grey area ones. Best thing to do, again, book a call with me or pop me an email, and we can talk in a little bit more detail about exactly what you're up to, and yeah, figure out whether it does qualify or not.
Thank you, Mike. We've got a question from anonymous user. Does your organization offer a formal way to advise founders?
Um, Not 100% sure what you mean by that, but we advise founders pre-incorporation, founders separately from their startups sometimes if it's necessary, and then obviously startups themselves. So we're very happy to sort of talk to you about what you might be planning to do, sort of how to set up your business, how to raise investment, all that kind of stuff. Initial calls and things like that we don't charge for. So again, if you wanna book a call with me, we can chat through whatever it is you want to talk about, and sort of see where to go from there.
Thank you. We just received some clarification on that on this question. I believe that they're asking if we have a way to support founders in a formal way, even when they are not investment ready.
Yeah, absolutely. So again, it sort of depends at what stage you're at, but yes, absolutely we can. Yeah.
Thank you, Michael. We've got a question from Anna. Maybe one of a main business owner, or should there be more people in the company to lower risk in order to qualify?
So from a qualification perspective for SEIS and EIS, it makes absolutely no difference. So single founder or large numbers of people, HMRC don't care. They're looking at the business itself, what it's going to do, and how it's going to spend the money. From an investor perspective, I mean, there are lots of views on this. So up until fairly recently, there was a sort of, I don't think it was a view that there were lots of founders who kept hearing that investors wouldn't invest in single founder companies. And And that was something that people worried about. I just don't think it's true. So we have actually a very large number of single founder companies. The way to plug the skills gap, as a founder, you can't do everything. You're not an expert at everything. The way to fill that gap is to bring on advisors, bring on team members, bring on employees. You don't have to have other co-founders if you don't want to. So I would say, if you've identified a sort of a skills gap of things that you can't do yourself, then bringing on a founder is one way of resolving it, but you can resolve it by many, many other ways. And I think you just need to be able to justify to an investor, how and why you've done that. Um, just just another practical point. There's a big move in the market around female founders at the moment. So historically, female founders have been relatively poorly represented in the UK startup market. That's improving dramatically. But what you will find is there's lots of VCs who are sort of very enthusiastic about promoting female-led companies. Some of them specialists, so Diversity X, I think, is a VC that works very closely with female founders. But actually, a lot of the mainstream VCs will look sort of they'll be very enthusiastic about it. So worth having a look at sort of groups that sort of help with that. So there's a bunch of female founder sort of networking groups who will sort of help network you for people who are particularly supportive of female founder companies.
Yeah, amazing. I can also add to that if you have an account with Enterprise Nation, they support founders and startups. They also have a very big group of female founders, so you can register for free and attend all of their networking events for the female founders.
Cool.
For everyone who is asking in respect of the recordings of the webinar will be available on our website by the end of tomorrow. You can go on our website at buckworths.com and click on our insights page, so they'll be available there. I'm just going to take a couple of more questions. Teja is asking how to reach investors.
So, I mean, it's sort of the stuff we talked about, right? So, I think the best way of doing it is to try to build a network, but at some point you're going to have to do cold outreach. Most of the early stage funds, you just make an application to their website. So if you look at SFC Capital, for example, they have an application sort of thing on their website. You just do it that way. Um, there are for clients there are things that we can do to help, but it's very much after the application stage. So if I give SFC as an example, I know the founders really well. There is zero point in me telling them about you before the application because the application has to go through sort of their process. So lots of people will review it and filter it to make sure that it meets their requirements. Once you've got through the filtering, sometimes me pinging a note to the founder and saying, by the way, these guys are pretty cool. Keep an eye out for them. Maybe it's useful, maybe it's not. But you sort of just have to sort of play with their process. With angels, it's not easy. Angels are very difficult to sort of to network because it's you have to find them at the right time when they're looking to invest. The best way of sort of accessing angels is going to networking events, going to pitching events, pitching to them, doing all that kind of stuff. What I wouldn't do, for what it's worth, is there's a whole bunch of these consultants, often with Mayfair offices, who will charge you a fee to link you up with angels and VCs. My advice would be the links to the VCs are absolutely meritless and pointless because you can do that yourselves. You're in no better position a consultant linking you through to SFC than you are making the application yourself. And on the angel side, my experience is most of these consultants don't really have networks of angels. They've got lists of people they may or may not know that they effectively cold outreach to. So I personally would say I wouldn't do that stuff. Just do the networking yourself and sort of do it that way.
Thank you. And just final question, we have a follow-up question from Sanjeev, who has asked earlier about the biofuel R&D. He's asking, is there any ballpark for this service?
Um, so it sort of depends. So the way that we charge, we try to do fixed fees for early stage clients. Those fixed fees depend on your particular business. So you can have an advanced assurance for a fairly simple business, like I don't know, a restaurant. That could be pretty cheap. You can then have an advanced assurance for a business that is like I don't know, a neobank, which is fiendishly complicated. And that's going to be, quite a meaty cost. So again, best thing to do. You're always welcome to book a call with me. We can have a chat, figure out exactly what your business is doing, and then we'll just give you a fixed fee quote for any work that you'd like done.
Perfect. Thank you so much, Michael, and thank you for all the questions, everyone, and joining us tonight. We hope that you enjoyed the workshop. As Michael mentioned, if you scan the QR code, you will be able to book a free consultation with him. That's only available for the next 30 days, so make sure that you book it within that time period. The recordings will be available tomorrow on our website, so you can rewatch them. We are very active on social media. We share lots of insights that are relevant to startups, spin-outs, scale-ups, and high-growth businesses on our website and LinkedIn page. So make sure that you give us a follow. And in terms of events, we've got another event coming up. It's on EMI and an approved option agreement. These are the option share schemes that are available to startups. Michael is going to go into a depth of discussing what is EMI and an approved option, how they work, who can get them, and if that's something that will be useful to you, you can join the webinar on February 27th of February on Thursday at 1 o'clock. It's lunch and learn seminar. It's free to register. You can either register to our website or do it on Eventbrite. Thanks so much for joining us and enjoy your evening.
Thanks very much, everybody. Bye bye.
Bye.